Let's get the big picture now with Howard Present. He's the president and CEO of F Squared Investment, a mutual fund investment firm that tracks market sectors through a series of indexes. Welcome, Howard, to Street Smart. We appreciate you joining us. Let me ask you first about something we just heard from Dan Deming, which I found very interesting. We see very low volume pretty much always now, unless we're seeing red arrows on the big board, and then we see higher volume. I always assumed that was because sellers come in to get rid of things on a down day, more conviction in selling than in buying. But Dan was saying that's because people come in to buy the dips. What does that say to you?
Well, actually, at our firm, we tend not to get into the scrum of sort of intraday trading volumes. But what we are seeing,
happening for years. This isn't intraday, right? Years.
It has been happening for years. And what's happening is that through all of this, the market just keeps chugging along. I mean, I find it pretty fascinating with all the stress in the market and all the misinformation and, if you will, counter-information. We just finished a first quarter of 2011. It was the single best first quarter of a calendar year since 1998. The market's had 2 consecutive calendar years of really sizable double-digit gains. So all of that activity out there, we continue to maintain a fairly bullish stance. In fact, right now we're very bullishly positioned.
So I wonder then, does it not matter anymore that we see low volume every day? I mean, we have been talking about this since before the March lows in 2009, but generally we always wonder skeptically, hey, even though we're up, there's low volume. Does it matter after 2 years of gains that low volume is persistent?
Well, apparently not. I will say this. We don't focus in on volume at all. We do pay attention to volatility. And volatility is something that I think has not disappeared. In fact, in the exact opposite, it's still with us. It was huge in 08, died down a little bit in the latter part of last year. It's back up again the first quarter this year. So I think the volatility you're seeing in the market is something to pay attention to, and that is something that definitely has not disappeared.
Since we're talking so much about low volume, Howard, hang on for a second, because we talked about this with Chris Heisey. He's got his own possible explanation. He's the Chief Investment Officer at U.S. Trust. Listen up.
I think what's happening right now is you see individual purchases of indexation, ETFs, things like that, instead of the individual movements of different shares of companies that are causing volume to be lower than what we would normally see in past cycles. We think that's a good thing, actually. That just means that there's still a wall of worry out there. They're anchoring positions in certain ETFs in terms of the mutual fund managers instead of owning individual companies that they feel comfortable with.
Howard, do you think that's a factor here as well in terms of the low volume that we're seeing as of late?
Yeah, I think there's a big trend there. I think there's another sub-trend which is actually, I think, going to emerge is very significant. And that's sort of, and moving away from the day trader mentality to more of the longer-term investors, where you're seeing a move away from traditional benchmark-hugging active managers. And you're seeing them now shift to managers who are actively managed, but have the ability of being able to adapt to market, especially down market volatility. And in fact, it's fascinating. You look at the last 14 months, $73 billion has come out of large cap value, large cap growth, actively managed mutual funds. If you take the 10 best-selling equity-based funds over the exact same time period, 43 billion in, 7 of those 10 have an emphasis on downside volatility management. So you're starting to see more packaging of these investments. ETFs are important. We only invest. We have over $2 billion of ETFs that we track at our firm. I mean, so I think that's going to have a dampening effect.
You work with ETFs, so that's exactly what you're seeing, correct?
Absolutely. That's all we do. Everything we do is an overlay on top of ETFs. When we have a view, we implement it by either owning the ETF or selling out of the ETF. So certainly from a stock volume, we're going to be able to help suppress a lot of that trading volume quite a bit that way.
Let me ask you quickly about the volatility, because you're talking about sort of downstream volatility here. We're seeing, though, a VIX of 16.5. If you pull up the VIX chart, it just comes down like it fell off a cliff, and then, well, here you see, look at there all the way on the right side of your screen. I mean, why does the so-called fear index not sort of represent what you're seeing here?
Well, we break it up. We don't look at it VIX, which is broad market. We try to break it out literally sector by sector, and you're going to see a big diversion there. You're going to see for sectors like energy, which has really taken off on the volatility measure. You're going to see others like utility, consumer staples maintain a fairly low profile. So I think what some of the problem is when you're blending them together and trying to get a composite look called VIX, it's going to give you a slightly different look. There's huge dispersion of activity right now among the sectors. You know, you saw it even in the first quarter. Energy was up 17.5%. 2% as a sector. Utilities was up 2.5%. So I think some of the problem you've got to do is you got to get underneath the surface layer and drill down a little bit, and you're going to get a better resolution on the results.
I want to bring Adam in here to look at different, or show us, Adam, the different kind of investment strategy you've been looking at and the returns that you're looking at.
Well, I tell you, Howard, I'm practically going to be teeing you up for a free advertisement. I think you're going to like these numbers, but take a look, because maybe you can help us make sense of them. If you look at the average hedge fund, it's up this year. This is according to Bloomberg data, about 3,000 funds. The average hedge fund up 2.2% versus the S&P 6.1%. And the CRB Commodities Index, 9.1. Ironic, because hedge funds are investing in these assets. Of course, they're also hedged, right? So they're not just long. But help us understand what it is that you are doing that is effectively allowing investors to have truer returns, be closer to the market, as opposed to hedge funds, which are lagging and then taking huge fees. What's the difference? How do you do it?
Well, at our firm, what we do is, it's all about creating value. Our issue is we want to give reasonable participation in the up market, and then when the markets are heading down, number one word is to protect. So what we do is we look at 9 separate sectors, and individually, if we think a sector looking forward it has a higher potential to lose money, we sell it. And we actually have the ability to go all the way to cash. So if you think about it, we have elements that may mimic aspects of hedge funds. We can go to cash. We're not benchmark centric. We can sell out of entire sectors if we don't like them. The big difference is we don't leverage. We don't use shorts. We have no derivatives embedded in there. And what's nice is when the market's heading up, first quarter, we beat the S&P slightly. Last 2 calendar years, we're able to beat the S&P as well. Big protection in 2008, where we were down less than 2%.
So you have a strong record, which is obviously speaks well for you. On the other hand, we're getting some emails here saying this guy's a perma-bull. Tell us about the sectors that you don't like. Tell us about the sectors that you want to be away from.
Well, right now, we have all 9 sectors active. In January of this year, we had healthcare that was off. Since then, it's got stronger, and we turn it back on again. We're clearly not a perma-bull. In October of 2008, we were 100% in cash, stayed that way till early April of 2009. So by no means are we a perma-bull. In fact, if you go back to the second quarter of 2010, just a little over a year ago, almost a year ago, we had one point where we were down to just 2 of the 9 sectors active, and we had literally a 50% cash position for that 1 week period. So what we're trying to do is we're trying to listen to the market. We're trying to adapt. If the sector's telling us there's strength there and we think there's value, we want to own it. We're very quick to be able to pull the trigger and get out if we sense trouble.
And you've obviously done well, as we said before, growing assets under management from $250 million to $2.2 billion. Howard, thanks so much for joining us.